Let's also bring on board then K Ramanathan from ING Investment Management. Mr. Ramanathan, hi, afternoon. Good scale up in the markets today, as was the case yesterday as well. But the point is, can it sustain, or do you think it's just before time, or rather just some short time that the market is going to be back to testing 5250 thereabouts?
We expect the markets to continue to remain volatile. Yes, past 2 days rupee has sort of stabilized a bit. People on a daily basis look at the screen and trade possibly. But everything is not hunky-dory still. Just the minutes have been released. There is no clear direction in terms of pace of removal. But the general consensus is that the removal will start in the month of September. So until further announcements or statements from Fed presidents or the Fed chairman, if the rupee continues to remain stable, the markets could have a short-term pullback, but I presume it will be a short-term pullback. Markets actually, or the things have gone from bad to worse. Domestic economy still continues to falter. First quarter GDP growth also will be pretty low. There is risk to the RBI estimates of 5.5% in terms of growth. There is a lot of expectations of a recovery in the next few quarters, but unless monetary policy is also pro-growth and fiscally the government is constrained, so unless the confidence returns back to the entrepreneurs for setting up new capacities, which I don't see any reason why it should return back, given that we have elections around the corner also, and the fear of QE continuing to remain. Please remember, the actual QE reduction has not happened yet. Still it is fear. So obviously we expect the market to continue to remain volatile, although there could be some short-term pullback.
Ram, given the fact that we are living in these volatile times, specifically the banking aspect seems to be most vulnerable to a lot of these uncertainties. What is your call then on the banking sector?
We are underweight the financial sector. Yes, valuations of public sector banks are quite cheap, even after adjusting for a significant amount of restructured assets and slippages into their book values. But there is no near-term positive trigger except valuation. The guidance from several public sector banks is that the incremental slippages and restructuring will continue in the next quarter also. Even the numbers coming from the CDR cell also indicate that the pain is still there. So we are yet to see the peaking out in terms of incremental worries. So valuations will continue to remain low, and we will continue to remain underweight the sector. Only when we believe that the global worries have settled down in terms of QE, when the government can focus then on domestic economic recovery, and at the same time possibly the RBI also will be in a position to reduce rates. That's a time possibly to look at the banking sector per se. That I don't see it happening in the next couple of quarters.
Mr. Ramanathan, good rally when it comes to the metals basket. Is there still time to get into the sector and make money?
See, metals is a pack which is more stock specific rather than because if you see Hindalco, 50% of the profitability comes from Novelis. If you talk about Tata Steel, it's no longer just like Tata Motors, it's no longer a domestic demand recovery kind of a story. So it is very difficult to generalize this sector per se. Having said that, I would be neutral on this sector rather than overweight this sector as of now.
What about the IT pack? Would you continue to be overweight like most of the analysts and fund managers on the market? IT, do you think is still a buy?
Yeah, I would continue to think so. While I realize it is a consensus buy, and portfolio positioning, whether it's FIIs or domestic, is overweight IT, there are still merits in terms of continuing to be overweight IT. Valuations, except for very few stocks, are not that expensive for the earnings growth which they are expected to exhibit over the next 1 year. while rupee depreciation will surely benefit them, the numbers in terms of estimates do not factor in 64, 65 rupees to a dollar. They still factor in close to 60 rupees to a dollar.